Welcome to the Deep Dive, where we take you straight into the heart of what matters. Today, we're tackling KeyCorp's first quarter earnings call for 2025. Our mission really is to pull out those essential insights, what you need to understand their performance and where they're headed strategically.
Yeah, and KeyCorp's first quarter, it painted a really interesting picture, actually. So on the top line, revenues jumped by a pretty significant 16% compared to last year. And what's quite remarkable, their expenses stayed essentially flat.
Flat in this environment.
Pretty much flat, yeah. And that combination, it really fueled a notable increase in their pre-provision net revenue, coming off the fourth quarter.
Okay.
What's also encouraging, I think, is the trend in their credit health. Non-performing assets, NPAs, they declined by nearly 10% sequentially.
Mm-hmm.
So yeah, ultimately they reported earnings of 33 cents per share.
Okay, let's unpack this a bit then. That 16% revenue jump, that really stands out. What were the key drivers behind that, especially, given the current economic climate?
Right. Well, a big piece of that was definitely the growth in their net interest income. That hit $1.1 billion.
$1.1 billion. Wow.
Yeah. And that's up both sequentially, so quarter over quarter, and significantly year over year, like 25%. This increase, it was largely driven by some, let's say, strategic moves they made back in the previous quarter.
Okay, like what?
Well, things like repositioning their securities portfolio, which was sort of connected to that Scotiabank investment you might remember.
Ah, right, the Scotia investment.
Exactly. And we also saw benefits from fixed rate assets and swaps repricing. Plus, there was a deliberate shift in their loan mix. They're moving away from some lower yielding consumer loans towards higher yielding commercial and industrial or C&I loans.
C&I, okay.
And on top of that, they've been actively managing their deposit costs, keeping those betas in check. That's definitely helped the bottom line.
You mentioned deposit betas being stronger than expected. Maybe just quickly, for folks less familiar, what does that signify here?
Sure, yeah. So deposit beta, it basically just measures how much a bank's deposit rates change when market interest rates move. So a stronger than expected beta, like they saw, means their deposit costs haven't climbed as deeply as maybe you'd anticipate given the rate hikes. That's definitely a positive for their net interest margin.
Got it. Okay, so it sounds like a combination of proactive strategies really boosted that net interest income. What about the other side, non-interest income?
That also saw an increase about 3% year over year. Mm-hmm. Not quite as dramatic, but still solid. And what's really notable there is their investment banking division. They had a record first quarter for fees.
A record?
Yeah, $175 million, driven mostly by strong activity in syndication and debt capital markets. M&A, merger and acquisition activity also stayed pretty healthy, and they're saying their pipeline there looks historically elevated.
Okay.
And another area, their commercial mortgage servicing business. That also hit a record high in fees, grew about 36% year over year.
Commercial mortgage servicing fees at a record. That's interesting. What does special servicing mean in that context? And why is a high volume significant?
Right. So special servicing, that usually kicks in when commercial real estate loans become distressed, when borrowers run into trouble. So yeah. A high volume there, like the $12 billion I mentioned in active special servicing assets. It suggests there are more borrowers facing difficulties, which leads to increased fees for KeyCorp because they're the ones managing these complex situations. It hitting an all-time high really points to a significant market trend they're, capitalizing on.
Makes sense. Now, let's circle back to expenses. You said flat year over year. How did they manage that when, costs seem to be rising everywhere?
Well, yeah, overall expenses were stable year over year on an adjusted basis, and actually down about 8% from the prior quarter. So that reflects some focus on efficiency clearly. But management did signal that they do expect expenses to sort of tick up throughout the year.
Oh, okay. Why is that?
Mostly due to planned investment spending, technology, talent, plus typical things like salary increases and just seasonality effects. So not flat going forward necessarily.
Right. Understood. Okay, moving on to credit quality. You mentioned positive trends earlier. Can you elaborate on that a bit?
Certainly. Yeah, we saw a sequential decrease quarter over quarter in net charge-offs. Those are loans they deem uncollectible. They were down about 4%.
Right.
That translates to about 43 basis points of average loans on an annualized basis. Non-performing loans also declined pretty significantly, actually, down 9%. So their NPL ratio dropped to 65 basis points.
So generally improving metrics.
Yeah, exactly. And even criticized loans, which are ones showing potential weakness, they were down slightly too, about 1%, mainly driven by improvements in commercial real estate, interestingly.
Interesting is right, because despite these improvements, they still added, $8 million to their reserves for credit losses. Why do that if things are looking, better?
Yeah, that's a really crucial point, isn't it? So while their current credit metrics did show those positive trends, management pointed directly at the ongoing macroeconomic uncertainty. That was the reason for the reserve build.
So caution.
Prudence, yeah. It suggests they're, bracing for potential future economic headwinds, even though their current book is performing well. They actually put a number on it, sort of. They said this reserve reflects a potential economic weakness scenario that they see having roughly a 20% probability.
Okay, so building a buffer just in case. Let's shift gears then to their capital position. Their CET1 ratio, Common Equity Tier 1, looks strong at 11.88%. What does that tell us? And why is being high within their peer group important?
Right. So the CET1 ratio is a core measure of a bank's financial strength. It's basically high quality capital versus risk-weighted assets. And 11.88% is, definitely strong. It indicates a really solid capital buffer, gives them resilience, to absorb potential losses. Being high relative to peers just means they're in a particularly robust position compared to other banks of a similar size. More cushion. They also mentioned a marked CET1 ratio around 10% or just under at 9.9%.
Marked. What's the difference?
The marked figure, it typically adjusts for unrealized gains or losses in their available for sale securities portfolio. So it gives you more kind of current market snapshot of their capital. Still strong at nearly 10%.
Okay. And with this strong capital, they've announced a share repurchase program, $1 billion. What does that signal about their priorities, you think?
Well, announcing a $1 billion buyback, that signals confidence in their capital levels, future profitability, and of course, a focus on returning capital to shareholders.
But they're not starting right away.
No, they said expected to commence in the second half of the year. And they're pretty clear the pace and the actual amount will depend on how the macro environment evolves, and also any final rules on Basel III endgame.
Right, the regulatory landscape.
Exactly. So while shareholder return is there, their main priorities, as they stated, remain, number one, supporting clients, then investing back into the business tech people, and also keeping an eye out for potential niche acquisitions. They're targeting a marked CET1 of 9.5% to 10%. So they have room.
Okay. Finally, let's touch on loan growth and the outlook there. It sounds like commercial lending is really where the action is for them.
Yeah, definitely. Loans were up sequentially overall, but that was primarily driven by a $1.2 billion increase in commercial loans. Their pipelines, they say, remain pretty elevated and, importantly, not hugely reliant on M&A activity kicking back in. Project loans are expected to keep funding. They also noted a slight tick up in utilization rates on existing credit lines. Businesses drawing down more. They expect that trend to probably continue.
Makes sense in this environment.
Yeah, and they saw particularly strong C&I growth, commercial and industrial, later in the quarter. Apparently it's quite broad-based, too, across different regions and sectors like affordable housing and renewables.
Interesting mix.
And one last point on that, the interplay between their debt capital markets business and loan growth. It seems they're holding slightly more of the capital raised for clients on their own balance sheet now, about 17% in Q1 versus maybe 15-16% previously. Meaning they're being a bit more opportunistic about growing their own loan book when perhaps market conditions get a bit choppy, taking advantage of dislocations.
Gotcha. And just to double check on commercial real estate, you said criticized loans were down there, but were there any other concerns?
They did mention that gross charge-offs in CRE were a bit elevated in the quarter. But they stressed it was really due to two specific larger names coming off the books. Not indicative, they believe, of a broader portfolio issue. They actually consider the overall health of their CRE portfolio to be improving.
Okay, good context. All right, let's move to our favorite segment. This is not financial advice. Okay, for outrageous but plausible trade idea this week, how about this one? You look at KeyCorp, right? Strong capital, they explicitly say they want to opportunistically grow during market dislocations, and that commercial mortgage servicing business, especially special servicing, is absolutely booming. So the idea, go long KeyCorp. But here's the twist. Maybe pair it with a short position in, say, a basket of regional banks, ones that maybe don't have that same capital strength, or maybe have higher exposure to sectors potentially hit by, say, new tariff talks, and less exposure to that lucrative special servicing fee income. You're basically betting on KeyCorp's relative strength and that special servicing angle while hedging against some broader regional bank weakness. What do you think?
That's definitely playing on their strengths. Alternatively, you could maybe think about it slightly differently. Given KeyCorp's big emphasis on technology investment, right, and the continued strength we saw in their investment banking fees, particularly DCM, you might consider, again, not advice, a long position in maybe a financial technology, a fintech ETF, paired perhaps with a short position in a more, let's say, traditional, less tech-focused regional bank ETF.
Interesting angle.
Yeah, the thinking there is KeyCorp's proactive tech spending could give them a real competitive edge, boosting those fee businesses even further, making them relatively more attractive, potentially, than banks that are slower on the tech uptake. Just another way to look at it.
Two interesting ideas there. Okay, that brings us to the end of our deep dive into KeyCorp's first quarter earnings. We've covered quite a bit their impressive revenue growth that focus on keeping expenses stable, the solid credit metrics, and their strategic thinking around capital. Now remember, these are just our observations from the call. The not financial advice segment is purely for informational, maybe entertainment purposes, definitely not recommendations.
Absolutely. We hope this analysis has given you some valuable insights into KeyCorp's current position and maybe their outlook.
Yeah, what are your takeaways? We really encourage you to do your own thorough research and analysis. Don't just take our word for it. Join us next time on The Deep Dive for another in-depth examination of the latest financial developments.